Good morning, students. In today's session, we will start with debt accounting. So let's start with accounting for issuance of debt. So your debt may be classified into long-term obligations and short-term obligations. How actually US GAAP defines long-term obligations? Let's see that. Long-term obligations are those scheduled to mature beyond 1 year or the operating cycle, if applicable, from the date of an entity's balance sheet. So you have your obligations, and those obligations may be long-term or short-term. And obligations that are scheduled to mature beyond 1 year or the operating cycle, those obligations are long-term obligations. Other obligations are short-term obligations. Now you generally take 1 year rule that if obligations are maturing after 1 year, those are long-term obligations. If they are scheduled to mature within 1 year, those are short-term obligations. But in certain cases, you do not use the 1 year rule, but you use the operating cycle rule. What actually is this operating cycle rule? And what actually is this operating cycle? So it is the average time between the acquisition of material and the final cash realization from sale. So what is the time between the acquisition of materials and the final cash realization from sale? That's your operating cycle. Your operating cycle may be for 6 months, 8 months, 12 months, 15 months, 2 years. But again, how you classify your obligations basis 1 year rule or the operating cycle rule? Generally, you use the 1 year rule, but you may use the operating cycle rule in certain cases. When you use the operating cycle rule generally if operating cycle is longer than 1 year. So if the operating cycle is longer than 1 year, you generally use operating cycle rule. This generally happens in case of, for example, in case of tobacco industry, distilleries, lumber businesses. In these businesses, operating cycle is more than 12 months. And when the operating cycle is more than 12 months, you generally do not use the 1 year rule, but you use the operating cycle rule. For example, let's say you are in lumber business and the operating cycle is 16 months. Then how you classify your obligations? You classify your obligations generally on the basis of your operating cycle, or your operating cycle is for 16 months. For example, then all the obligations that are scheduled to mature within 16 months are short-term obligations, and all the obligations those are scheduled to mature beyond 16 months are long-term obligations. Do you understand? Okay, so if your operating cycle is, let's say, 6 months, what rule you use to classify your obligation? 1 year rule or the operating cycle rule? You use 1 year rule. Operating cycle rule is applicable if your operating cycle is longer than 1 year. If your operating cycle is for 12 months or less, use 1 year rule to classify. If your operating cycle is more than 12 months, use operating cycle rule. So what is the length of your operating cycle? It is 12 months or less. Then for classification of obligations into long-term or short-term, what rule you use? You use 1-year rule. Another situation is that the operating cycle is more than 12 months. What rule you use to classify the obligations as short-term and long-term? Use operating cycle rule. If the operating cycle in your business is not clearly defined, that is, you are not really sure about the operating cycle, the length of the operating cycle, you're not sure. Then again, use 1-year rule. Any questions? Now, what are your short-term obligations? Those obligations that are scheduled to mature within 1 year or the operating cycle, if applicable, from the date of the balance sheet. And you classify these short-term obligations as current liabilities. You call them current liabilities. So what are your short-term obligations? Debts that arise in the normal course of business. Payables that arise in the normal course of business that are due in the customary terms are short-term obligations. Then debts that are due on demand. These are also short-term obligations. For example, you borrow and the term of borrowing is 5 years, let's say. So you have to repay after 5 years. But under the terms of borrowing, the lender can ask you to repay anytime. Although the term of the loan is 5 years, you have borrowed for 5 years, you will repay after 5 years. But under the terms of the contract, the lender can ask you to repay anytime. So that is debt that is due on demand. And you classify that as short-term obligation, not long-term obligation, although the term is 5 years. Also, currently maturing portion of long-term debt. For example, you have borrowed $100,000. This is a long-term loan, but out of this, $10,000 is maturing in next 12 months, let's say, or in next 6 months, or in next 2 months. You have to repay this amount in next 6 months, let's say. So this $10,000 is currently maturing portion of long-term debt, and you do not classify this $10,000 as long-term, but you classify this as short-term. So you will classify $10,000 as short-term and $90,000 as long-term. Any questions? Now let's talk about issuance of notes or bonds for cash. I will use these terms interchangeably. So notes, bonds, these terms are used interchangeably, mean the same. But how you record these bonds issuance? Notes payable or bonds payable. Notes payable should be recorded at the present value of the note. This is the key to this. Notes payable. We are talking about long-term obligations. Your notes, the borrowings, your debt. Notes payable should be recorded at the present value of the note. What is the present value? We will see. But always record a debt at its present value. Present value may be different under different circumstances. So whenever you're recording a debt, you have to ask this question, what is the present value? Okay, so notes payable should be recorded at the present value of the note, and the difference between the face amount and the present value should be recognized as premium or discount. All right. So if you are issuing notes for cash, we will also talk about non-cash transactions regarding bonds. But on this slide, we are discussing that you issued notes payable for cash. When you issue notes payable for cash, what is the present value of the note? Cash proceeds, cash that you are getting. That is the present value of the note. Let's say the face amount or the face value of the note is $10,000. You are getting a cash of $9,000. So what is the present value of the note? $9,000. Difference between face amount, that is, in this example, let's say it is $10,000. Cash proceeds are $9,000. The difference between the present value and the face amount is discount, that is 1,000. So how you record this? Cash debit $9,000, easy. Discount on notes payable $1,000. Notes payable credit, this is your liability, $10,000. You may issue note at a premium also. In that case, the journal entry that will happen is cash debit, notes payable credit, and you have premium. Let's say you issued $5,000 face value note payable for $5,800. $800 is premium in this case. What is the present value of the note? $5,800. You may issue notes payable at face amount at par. In that case, there is no discount or premium. You debit cash, credit notes payable for the same amount. Any question? Now let's read more. The entity should amortize premium or discount. So you amortize this. But how? As an element of interest. That is, as part of interest. This amortization is included in interest. What is this? Interest income or expense? This is interest expense. So this amortization of discount is included in interest over the life of the note using the interest method. So you know certain things. Firstly, you have to amortize this premium or discount. And when you amortize this, the impact is on interest. You amortize this over the life of the note, that is the term of the note. If the term of the note is 7 years, you amortize this over a period of 7 years, and you use the interest method. Now, what is this interest method? How you amortize this? So under the interest method, you use effective interest rate. What actually is this effective interest rate? You use effective interest rate to amortize premium or discount. To recognize interest expense, you use effective interest rate. You do not use the coupon interest rate. What is this coupon or stated interest rate? This is the interest rate that is stated on the note or the bond. Okay, you borrow against a note payable. You borrow $10,000 and the amount of interest that you are required to pay is 10%, let's say. This 10% is stated interest rate or the coupon interest rate, because this is what is stated on the note. This interest rate you are required to pay as per the terms of the contract. You call this stated interest rate or the coupon interest rate. But this may or may not be the effective interest rate, may or may not be. Generally, it is not. So you have to find out what is the effective interest rate, because I will recognize interest expense basis effective interest rate. I will amortize premium or discount using the effective interest rate. I have two interest rates. One is stated interest rate, one is effective interest rate. I have to find out effective interest rate because stated interest rate or the coupon interest rate is given to you. All right. So how you find this effective interest rate? That's the question. So this is the rate at which cash proceeds equal the discounted future payments. So you need to find out an appropriate discount rate at which your cash proceeds equal the discounted future payments. So at what rate? What rate you discount? Answer is effective interest rate. So you try different rates, practically if we talk about. So you try different rates and see at what rate, that rate may be 8%, 9%, 6%, 12%, 13%. You have to try different rates. So you try different rates and see at what rate cash proceeds equal discounted future payments. All right. So you determine effective interest rate. Now, basis this effective interest rate, you recognize interest expense and also amortize premium or discount. But how? Let's see this. All right. So you determine effective interest rate, and now basis that we will calculate interest expense. Your interest expense is the outstanding amount of notes payable multiplied by effective interest rate. From interest expense, you subtract coupon interest, or you also call this nominal interest. And you get the amount of premium or discount that is amortized for a particular period we are talking about. So what is interest expense for, let's say we are talking about year 2. So what is interest expense for year 2? What is premium or discount amortized for year 2? We are calculating this. What actually is this outstanding amount of note payable? This is face amount of note payable plus unamortized premium minus unamortized discount. You get outstanding amount of note payable. Any question? Let's say X company issued a bond and the face value of the bond is $100,000. Coupon rate of interest is 10%, and this is payable annually. And the term is 3 years. So this is a 3-year bond. You have issued this. X company has issued this. Let's say this is issued at par. There are 3 situations. You may issue this bond at par, premium, or discount. And how you calculate this premium or discount? It is the difference between the face amount and the present value. What is present value? Cash proceeds that you have received. Let's say cash proceeds are also $100,000. This is one situation. Because cash proceeds equal the face amount. There is no premium or discount. This is issuance at par. Easy example. So how you record this journal entry? So this is, let's say it is on January 1, year 1. Cash debit, bond payable, credit, $100,000. No premium, no discount. December 31st, year 1. You will do journal entry to record interest expense. What journal entry you do? Interest expense, debit, cash, credit. There is no premium or discount. Therefore, there is no premium or discount amortization. And whatever you are paying, that is your interest expense. So your interest expense is $10,000. And the same entry is repeated in year 2 and year 3. Any questions? If you are repaying at the end of year 3, now let's modify this question a little and let's see what's the impact. Let's say coupon interest rate is not 10%, but 7%, and the effective interest rate is 10%, and cash proceeds are not $100,000, but this amount, 92,540. Why? Because the coupon interest rate is less, effective interest rate is high. Because coupon interest rate is less than the effective interest rate, the cash proceeds that the company will receive is less, because this effective interest rate generally, not always, generally reflects the market interest rate. That if you invest in this type of industry for this term under these terms, then the effective interest rate or the market interest rate should be 10%. Because the company is giving less than the market interest rate, company should be giving 10% interest rate, but company is only giving 7% interest rate. So company will issue bonds at a discount. Otherwise, public will not buy these bonds. Public will not buy these bonds because interest rate is low. Interest rate is only 7% compared to 10%. At what price company issued the bonds? 92,540. Company issued the bond at 92,540, is giving interest of 7%. Considering this, we have calculated that the effective interest rate is 10%. How you calculate effective interest rate? Generally, it represents market interest rate, but it is not that you take the market interest rate and call it effective interest rate. That is not true. Effective interest rate is the rate at which cash proceeds equal the discounted future payments. That is the effective interest rate. So you have calculated this. Cash proceeds 92540 should equal the discounted future payments on this bond. What are the future payments? Interest and principal repayment. So you discount interest, you discount principal repayment, you should get to 92,540, because that's the basis we have used to calculate the effective interest rate. All right. So if this is the data that you have, then on January 1, year 1, what journal entry you record? You debit cash. You debit discount on bond payable, and you credit bond payable for the face amount. Discount is difference between the face amount and the cash proceeds. That is the present value. This is present value of the note. Always record a bond at the present value. How you are recording this? So that is this is the present value of the note. Any question? Now you have to amortize this discount and also record interest expense, because there is discount. This discount amortization has impact on interest expense. So let's calculate interest expense and discount amortization for all the 3 years. And for this, we will prepare discount amortization schedule. Let's prepare that. That will make framing journal entries easy for us. We are preparing this schedule for 3 years. 1, 2, 3. We need to know the beginning outstanding amount, right? Effective interest, stated interest or the coupon interest or nominal interest, discount amortized, and ending outstanding amount. All right. This is the beginning outstanding amount. How you calculate this? That is face amount minus unamortized discount, which is 7460. You get to 92540. All right. Whenever you have to calculate outstanding amount of bond payable, you do it this way. What is effective interest? That is the interest expense. This is expense. How you calculate this? This is effective interest percentage multiplied by outstanding amount. That is what is stated interest or the coupon interest? 7% multiplied by face amount. Difference of these two, A minus B, is discount amortized. That is 2254. And what is the ending outstanding amount? Again, you take $100,000 minus unamortized discount, because your discount was 7460. Out of that, you have amortized 2254. So 7460 minus 2254. This is unamortized discount. You get to a figure of any question? Let's do it for second year. Ending outstanding balance becomes the beginning outstanding balance for the next year. Effective interest is 10%. Stated interest is 7% of face value. It is not changing. Difference of these two is discount amortized. Ending balance is 97,273. Again, you calculate effective interest. This is 10% of 97,273. That is 9727. Stated interest does not change. Difference is discount amortized, and ending balance is $100,000. Any question?
Excuse me, sir, Vidya here. So in this question, if there is any interest component which is paid every year, then before ending outstanding, we will take interest paid portion.
In this schedule, which figure actually is representing interest paid?
Effective interest.
What others think?
It's coupon, stated interest.
Stated interest.
Yes, stated interest is interest paid. Effective interest is interest expense.
Okay.
If you are paying $7,000 every year to the bondholder, but $7,000 is not your interest expense. Interest expense is more because of the discount factor. All right.
Okay, got it.
Now you will record journal entry for interest and discount amortization. Interest expense debit. discount on bond payable credit, and cash credit. So the first year, what is your interest expense? 9254. You have already calculated this. Discount amortized 2254, and interest that you have paid is $7,000. Let's do it for year 2. 9479. Discount amortized is 2479, and 7,000 is interest paid. Again, for year 3, same entry. And then on December 31st, year 3 at the end, if you repay this bond, any question? Let's modify this question again. Let's say that the coupon interest rate is not 7%, but it is 12%. Cash proceeds are 104,974. Basis this, you calculate the effective interest rate, which is 10% again. Because your coupon interest rate is 12%, and this is higher than the market interest. So you are charging more for the bonds. Issuance price is more. There is an element of premium. What is premium? 4974. So what journal entry you will record on January 1, year 1? Cash debit, bond payable credit, and premium on bond payable, again credit. This is $100,000. How much cash we are getting? This premium is. Any question? Now there is an element of premium. You amortize this premium, calculate interest expense, and record the journal entry. In the earlier example, there was discount. Because of discount, your interest expense was more than the interest that you were paying. You were only paying $7,000, but interest expense was more than that every year. In the first year, it was 9254, then it was 9479, then 9727. It was higher than $7,000. Why? Because of discount. You were amortizing discount. Here you have premium. Because of an element of premium, your interest expense will be less than interest paid. So if you're paying $12,000 interest, your interest expense will be less than $12,000. Let's see. So what is the beginning outstanding amount? It is 104,974. That is the face amount increased by unamortized premium. Unamortized premium as of now is 4,974. What is your effective interest? It is 10% of this amount. That is 104,997. Stated interest 12,000. 12% multiplied by face amount. Face amount is $100,000. This will not change. Every year you will pay $12,000 interest. Every year you will pay this amount. Premium amortized is the difference between these. And then you have ending outstanding, that is face amount plus unamortized premium. And this comes to 103,471. This becomes the beginning balance for the next year. Effective interest is 10% of this. Difference of these two is premium amortized ,10% of this. How you calculate this? This is face amount plus unamortized premium, and your unamortized premium is 4,974 minus premium amortized in the first year 1,503. That is 103,471. Any questions? Let's record this. You know all these figures because you have calculated these figures in premium amortization schedule. You're using the figures from that schedule. On December 31st, year 3, if you repay, any question? If you issue notes or bonds for cash, accounting is easy. We have seen this. But when you issue notes for property, goods, or services, then accounting may require you to compute few other things and maybe little different, particularly with respect to calculating present value. You know that you record notes payable or bonds payable at present value. And in case you are issuing notes payable or bonds payable for cash, present value equals cash proceeds. But when you are issuing notes for property, goods, or services, then calculating present value may require considering few things. Let's see those. Notes exchanged for property, goods, or services are valued and accounted for at present value. That we know. So notes exchanged for property, goods, or services are valued and accounted for at present value of the consideration exchanged between the contracting parties at the date of the transaction in a manner similar to that followed for a cash transaction. The present value of the note is not same as the face amount of the note. So what you are giving a note. What you are getting property, goods, or services. Let's understand it this way, that you receive an asset from X. You receive an asset from X and you issue bonds to X. Face amount is $100,000, let's say. Now the question is that, what is the present value of the note? Because you record these bonds at present value. You know the face amount, but do you know the present value of the bonds? And what it says, the present value of the note is not same as the face amount of the note. I'm using these terms, notes and bonds, interchangeably. So present value of note is not same as the face amount of the note. It is not same. So in this example, they are saying that face amount, that is $100,000, is not the present value. Why? Because interest is not stated on note. There is no interest, no coupon interest, or coupon interest rate is zero. Because coupon interest rate is zero, present value is not $100,000. Then what is present value? How you calculate that, we will see. But present value is not $100,000. It is saying that. So we have to keep this in mind, that in these three circumstances, present value is not face amount. Second, stated interest is unreasonable. You issue bonds. Interest on these bonds is only 1%. When the market interest on such bonds generally is 8%. So the stated interest is unreasonable. Then also you say that present value is not $100,000. What is present value? We will see. We have to calculate. But for sure, present value is not $100,000. Third situation, when present value is not $100,000, present value is not equal to face amount. It is that when the stated face amount, that is $100,000, is materially different from either the current cash sales price, that is fair value or the exchange price for the same or similar item. Item is asset. We are talking about in this particular case, asset. So the face amount is materially different from the fair value of asset. For example, let's say the fair value of this asset is only $30,000, for example. Then this face amount is materially different from the fair value of asset. Because face amount of bonds is materially different from the fair value of asset, we can say that present value of the bonds is not $100,000. Then what it is, we will see. We will calculate. The stated face amount of the note is materially different from either current cash sale price or the fair value or the exchange price of the asset or the fair value of the note. Suppose you do not know the fair value of the asset, but you know the fair value of these bonds because these bonds are traded on stock exchange. They are listed on stock exchange and they are currently traded for, let's say, $40,000. So you know the fair value of the bonds. And this fair value of bonds, $40,000, is materially different from face amount. This $40,000 is different from face amount, $100,000. Because these two are different materially, you can say that present value of bonds is not $100,000. Present value of bonds is not $100,000. Any question? So this point actually is telling you that in which all circumstances present value of bonds is not equal to face amount. 3 circumstances. All right. Then how you calculate present value?
So one thing, sir. Any of these 3 conditions, no, sir? Or
Yes.
you
We have to calculate present value. What it is? If the present value of the note is not same as the face amount of the note, and this we know happens in 3 circumstances. This happens when notes are exchanged for property, goods, or services, and interest is not stated, or interest is unreasonable, or face amount is materially different from the fair value of asset or the fair value of the note. This happens in these 3 circumstances. So if present value of the note is not same as the face amount of the note, then what? Note, sale price, cost of property, good, or service exchanged, everything. The note, the sale price of the goods, the cost of asset that you have received against the note should be recorded at what? Fair value of property, good, or service, or the fair value of the note, whichever is more clearly determinable. So you use either the fair value of the note or the fair value of the asset. But we are talking about this for these 3 circumstances. For these 3 circumstances, this rule applies. But there may be transactions which do not fall in these 3 points. In those cases, present value of the note equals the face amount. So if present value is not equal to face amount of the note, then you use the fair value of the asset or the fair value of the note, whichever is more clearly determinable. Now, what the second sentence says, this is interesting. In the absence of established exchange prices for the related property, goods, or services, or evidence of the fair value of the note. So in the absence of established exchange prices for the related property, good, or service, there are no exchange prices. That is, you cannot determine the fair value of the asset. You cannot determine this. And also there is no evidence of fair value of the note. You cannot determine the fair value of the note. Because if you can determine the fair value of the note or the fair value of the asset, then you record this transaction at the fair value of the asset or the fair value of the note. But if you cannot determine both, you cannot determine the fair value of asset, you cannot determine the fair value of bonds, then what will happen? Then the present value of the note that stipulates either no interest or rate of interest that is unreasonable, because we are talking about these 2 points. Why only these 2 points? Because this actually talks about the fair value and we cannot determine fair value. So this actually is relevant when interest is not stated or interest is unreasonable. All right. Let me read again. In the absence of established exchange prices for the related property, goods, or service, or the evidence of the fair value of the note, the present value of the note should be determined. You have to determine this by discounting all future payments on the note using an imputed rate of interest. So you have to determine the present value of the note. You issue a note for cash. What is the present value of the note? Cash proceeds. You exchange note for property, good, or services. General rule, You can take the face amount, but if the transaction falls in any of these three circumstances, then you take the fair value of the note or the fair value of the asset as the present value of the note. But if you do not know the fair value of the note or the fair value of the asset, then you have to determine the present value of the note by discounting future payments. All the payments that you have to make in future, generally it includes interest and principal repayment. So you discount all the interest payments and principal payments and get to the figure of present value. You use that discounted amount as the present value. But you discount that using what rate? Using an imputed rate. What is imputed rate? Estimated rate. You have to estimate. This is not effective interest rate. But yes, it becomes an effective interest rate later, because effective interest rate is the rate at which cash proceeds are equal to present value of future payments. That is the effective interest rate. Okay, so this is cash inflow and these are cash outflow. You can calculate effective interest rate. That we have seen in the example that I just did, that what is the effective interest rate? We can calculate effective interest rate when we know what is cash inflow and what is cash outflow. But here in this particular case, we do not know how much is inflow. We know the outflow because like we will be making interest payment, we will be repaying this amount, but we do not know the inflow. We also cannot calculate the effective interest rate because we do not know what is the amount of inflow. We know that we are receiving an asset, but we do not know the fair value. We do not know what is the value of asset. We do not know the present value of the note. Because of this, we do not know the effective interest rate. Again, coming back to this thing that if we do not know the fair value of note, we do not know the fair value of asset, but we still need to calculate the present value. And we calculate present value by discounting all future payments. And we discount these future payments using an imputed rate of interest. This is the rate that you estimate. So you estimate an interest rate. And when you estimate this interest rate, you consider various factors. For example, what is the credit standing of the borrower? What is the published market rates for similar quality bonds? What is the incremental borrowing rate for the borrower, etc. You consider various factors and try to determine what should be an interest rate. It is more of a qualitative assessment. It is less mathematical. You do not use statistics or mathematics to calculate imputed rate, but it is more of a qualitative assessment. You're trying to just estimate it, determine it, considering various qualitative factors. What is the credit standing of the borrower? Borrower issues similar type of bonds in the market. What is the amount that is likely to be received by the borrower? What is the incremental borrowing rate, or what are the published market rates for same types of bonds? You are trying to determine, you are estimating. You estimate that, okay, imputed rate of interest should be 8%, let's say. So you estimate this. Now you know the rate of interest, and using this 8% imputed rate of interest, you will discount all the future payments and come to the figure of present value. Any question? Now let's discuss these three situations with examples. Okay. So let's say face amount of bonds is given to you So you need to know this present value in order to record this transaction, issuance of bonds. So you have issued bonds, you have issued it for property, let's say for some asset. So issue bonds and receive an asset. To record this transaction, you need to know the present value of the bonds. You know the face amount of the bonds. Interest rate is 0%. Fair value of the asset, you do not know. Fair value of the bonds also, you do not know. What is the present value? Can anyone tell me how to calculate the present value of the note in this case?
We need to have imputed rate of interest, and then
Yes, we need to calculate the imputed rate of interest. First thing is that it falls in the exception, that the face amount is not equal to present value. Present value is different from face amount. Why? Because the interest rate is 0. All right. Second thing is that in such a case, present value of the note is equal to the fair value of the asset or the fair value of the bonds. But both fair value of asset and fair value of bonds, we do not know. In such a case, we need to determine imputed rate of interest and discount all the future payments using that imputed rate. The discounted amount that we get is the present value. So in this case, let's say the imputed rate is 10%. Can anybody tell me what are the future payments? These are 3-year bonds. What are future payments?
Interest and principal.
Are you sure? No interest, because interest is 0, only principal repayment. So future payments include only principal repayment at the end of 3 years. Okay. So you discount that at 10%, and let's say you get to the figure of 75132. This is the present value. Right. What journal entry you will record? Let's say this transaction is happening on January 1, year 1. Asset debit. Discount on bonds payable, debit, and then bonds payable, credit. Now, what next you will do? What next is to be done here? How you will move forward in this example? What you will calculate next? What you need to know? What you need to calculate? What you need to prepare? You will prepare discount amortization schedule. Prepare that. What is the effective interest rate? In this case, 10%. What is stated interest rate or coupon interest rate? 0%. Considering this, you can calculate discount amortization, interest expense. Any questions? Let's take another example. Face amount of bonds is given to you $100,000. Because you issued bonds and received an asset in exchange. Stated interest rate is 1%. Fair value of asset is 77618. This is given. What is the present value of the note? Can any of you tell me what is the present value?
77618, because we have been given fair value of the asset, and yeah, no, one more thing, we need to see whether the stated interest is materially different.
Because fair value of the asset is materially different from the face amount of the bonds. Right. Second, stated interest rate also seems to be unreasonable. If the stated interest rate is unreasonable or the fair value of the asset is materially different from the face amount of the bonds, then you do not take present value equal to $100,000, but you take present value equal to fair value of asset or the fair value of note. In this case, fair value of asset is given to you. You will use this figure. And what next you will do? You will prepare a discount, amortization schedule, then you have the stated interest rate 1%, and you need to know the effective interest rate, so you have to calculate that, which in this case is 10%. That is, the present value of the note is equal to discounted future payments. The rate at which present value of the note is equal to discounted future payments, that is the effective interest rate. I've calculated that, and it is 10% in this example. So what journal entry you will do? Asset debit, discount on bonds payable, and bonds payable credit. Any question?